Today, we're tackling one of the biggest money questions in Canada right now, especially for newcomers and first-time investors. TFSA versus RRSP. Which one should you use first? Because here's what's happening. Canadians are trying to build wealth in an economy where rent is high, groceries are up, and interest rates have been a real factor in household budgets. And in the middle of all that, people are hearing two completely different messages online. One side says, RRSP is the smartest move, tax refund. The other side says, TFSA is unbeatable, tax-free growth. So which one is actually better? Tonight we're not doing hype, we're doing clarity. By the end of this video, you'll know the difference in plain English, the most common mistakes beginners make, and you'll get 3 simple investing rules, Vanguard-style principles that can keep you on track even when markets get scary. Quick disclaimer as always, this is general education, not personal tax advice. Let's get into it. First, the headline. A lot of people treat TFSA and RRSP like they are investments. They're not. They're accounts, containers, like a wrapper around your investments. Inside a TFSA or an RRSP, you can hold cash, GICs, mutual funds, ETFs, and stocks. The account is not the strategy. The strategy is what you put inside. Now here's the simplest definition you need. TFSA. Your investments can grow and your gains can be withdrawn tax-free. RRSP. Your contributions can lower your taxable income today, but withdrawals are typically taxed later as income. So TFSA is about tax-free growth. RRSP is about tax relief now and tax later. And that leads to the key question. Is it better to save on tax today or avoid tax later? The answer depends mainly on one thing, your income level now compared to what it will likely be later. Let's break it down with a quick example. If you're earning a moderate income, say your early career, or you're newly settled in Canada, your tax bracket may not be that high. That means an RRSP contribution doesn't save you as much tax right now. In many cases, the TFSA becomes the better first step because it delivers tax-free growth and, very importantly, flexibility. You can withdraw without paying tax. You can recontribute later, and if life happens, job changes, relocation, emergency expenses, you're not punished for accessing your money. On the other hand, if you're earning a higher income, let's say you're into a higher tax bracket, RRSP can become extremely powerful because that contribution can produce a meaningful tax refund, sometimes thousands of dollars, which you can use strategically. Now, I need you to pause right here because this is where a lot of people get it wrong. RRSP is not magic just because it gives you a refund. RRSP becomes powerful only when you do one specific thing. You don't treat the refund like free spending money, because plenty of people do this. They contribute to RRSP, get a refund, and then spend the refund. Vacation, new phone, random shopping. And what happens is the strategy loses a big part of its long-term advantage. The disciplined approach is this. Contribute to RRSP, receive refund, then invest the refund or use it to pay down high-interest debt. That's how compounding accelerates. Now, there's also one factor that jumps ahead of this debate almost every time. Employer matching. If your employer offers a plan where they match your contribution, group RSP, pension plan, or similar, taking that match is usually the #1 move, because employer match is basically an instant return. If you contribute 4% and they add 4%, you doubled that portion immediately. No stock market return is guaranteed like that. So for beginners watching right now, here's a simple priority list without overcomplication. If there's employer match, take it first. Then decide between TFSA and RRSP based on your income and your need for flexibility. Now let's go deeper into what TFSA actually does because TFSA is widely misunderstood. The name includes the word savings, so people assume it's only for cash. but TFSA can hold investments. And if those investments grow, if your ETF goes up, if your stock portfolio goes up, that growth is sheltered from tax. Also, TFSA has a special feature. When you withdraw, you do not lose that room forever. You get the contribution room back later. That matters because it means TFSA can be used for multiple goals: emergency fund, down payment savings, medium-term goals, and long-term investing. Now compare that to RRSP withdrawals. When you withdraw from RRSP, there is typically withholding tax deducted immediately. And in many cases, you do not get that contribution room back. That makes RRSP less flexible for short-term needs, which is why, for many beginners, TFSA is the safer starting point. But now, let's address the other side. Why RRSP is a big deal for higher earners. RRSP contributions lower your taxable income. The higher your income, the more valuable that deduction can be. And here's how to think about it in simple terms. If you're in a high tax bracket today, RRSP lets you reduce tax at a high rate now and potentially withdraw later at a lower rate, especially in retirement when many people have lower income. That's a huge advantage. But again, only if the investing behavior is consistent. Now let's deal with a question Canadians ask all the time. What about the home buyer's plan? Doesn't that make RRSP the best option if I want to buy a house? The home buyer's plan allows eligible buyers to withdraw from RRSP for a home purchase. But it's not a free withdrawal. It's structured as a withdrawal you generally have to repay over time. If you don't repay on schedule, it can become taxable income. So yes, RRSP can help with home buying for some people, especially higher earners who get big refunds. But TFSA can also be very effective for down payment planning because withdrawals are tax-free and there's no repayment schedule. So the takeaway here is not RRSP always for home or TFSA always for home. The real takeaway is your income level and your cash flow stability should drive the decision. Now, I want to bring in the news channel reality check moment. Most Canadians don't need perfect financial optimization. They need a plan that is simple enough to follow and strong enough to survive real life. So here is a practical framework you can apply tonight. If you are still building a stable financial base, no emergency fund, inconsistent cash flow, lower to moderate income, TFSA is often the best first move. If you are in a higher income bracket, stable, and committed to long-term investing, RRSP becomes a priority, especially if you reinvest the refund. And if you have employer matching, take it first. Now that's the account decision, but now comes the part that determines whether you actually win long-term, what you invest in. Because you can pick the right account and still lose money by making classic beginner mistakes. This is where the 3 Vanguard-style principles come in. I'm calling them that because they represent the boring, long-term approach used by millions of serious investors: low cost, broad diversification, and discipline. Principle number 1, costs matter. Fees are not just small numbers. Over decades, fees can remove a massive chunk of your wealth. So when you're choosing investments inside TFSA or RRSP, low-cost diversified ETFs or index funds are often a strong starting point for beginners. It's not about being fancy, it's about not bleeding money quietly. Principle number 2, diversification beats prediction. Beginners often think investing is about guessing winners. The reality is, long-term success is more about avoiding big mistakes than hitting jackpots. Diversification means you're not betting your future on one company, one sector, one country. And in Canada, diversification matters even more because Canada's market is concentrated in a few sectors. That's why many long-term investors add global exposure rather than putting everything only in Canada. Principle number 3, stay the course. This is the hard one, and it's the one that separates people who build wealth from people who quit. Markets drop. It happens. When markets drop, panic selling is the most expensive mistake beginners make. Staying the course means you invest consistently, you don't let headlines control your actions, and you stick to a plan you can live with. And the best way to stay the course is to automate your investing. Automatic contributions remove emotion from the process. Now, we need to address a warning specific to TFSA. TFSA overcontribution can trigger penalties. So do not guess your contribution room. Check it using your CRA account. And one more warning. TFSA is not designed for frequent speculative trading. If you're day trading aggressively inside TFSA, it can create complications. For most beginners, TFSA is best treated as a long-term investing tool. Now, at this point, some of you are thinking, okay, just tell me exactly what to do. Here's the action plan, simple and realistic. First, check if your employer offers matching contributions. If yes, contribute enough to get the full match. Second, check your TFSA and RRSP contribution room using your CRA account. Third, start automatic contributions. Even a small amount, consistently, is better than waiting for the perfect time. Because here's the truth, the most dangerous investing strategy is doing nothing while you keep thinking about it. Now let me summarize the decision rule one more time because this is what people will remember. If you're early career, moderate income, or you need flexibility, TFSA is often the best first step. If you're higher income and disciplined, RRSP is powerful, especially if you reinvest the refund. And if employer match exists, take it first. Now I want to end with a statement that might sound boring, but it's the truth. Wealth is built by regular people doing regular things consistently, not by constantly switching strategies, not by chasing the newest trend, not by trying to time the market. It's built through low fees, diversification, discipline, and time. TFSA and RRSP are powerful tools in Canada, but they only work when you use them consistently. So here's your challenge right now. After the video ends, spend 5 minutes. Check employer matching. Check your contribution room. Set up an automatic contribution.